I don't want to call it tech wreck because the conditions which led to the rally in these stocks still exist. So the conditions are still extremely favourable, but this leverage needs to unwind at this point. Everyone overestimates the change that will happen with the world. Like, you look at the events we've gone through over history and nothing really changes dramatically. The way a macro thematic plays out is not in a linear fashion. You'll get movements in the underlying macro drivers and we will up and down our weights based off that. So I think financial is a very neglected sector and neglected for a good reason, but I think the conditions are almost right for a rebound in this sector. The key thing to watch is the US 10-year rate and the spread between the 2 and 10 years, so the slope of the yield curve.
Matt, welcome to the show. Really, really great to have you here, and well done on an incredible year of performance. Your portfolio is positive in a year when the market went negative. So I'd really love to understand more about your process today. From what I get, WAM Leaders employs a sort of bottom-up and a top-down approach. Is that right? Maybe just walk me through how the process works.
Yeah, sure, no problem. So the way we look at stocks or the portfolio is a combination of that bottom-up, which you mentioned, but also the top-down. So the macro thematics play a very important part on how we manage the portfolio. The macro is like the lifeblood of the world, the economy, so we really need to pay respect to some of the movements there. So throughout the period, you had the big fall, the crash in March of the pandemic, but it created a lot of opportunities. Quite often markets go into oversold positions due to fear, and we were able to capitalise on these. And a few of the macro thematics as well around, especially the steel industry coming out of China. So the China strength was really a macro thematic we played. But it was really a combination of the macro thematics and the bottom-up process which allowed us to deliver results in an otherwise very tough year for people.
Okay. Now we'll go into some of those thematics in a moment. Something your colleague John Ayoub said, which was really interesting, was that you've got a very flexible mandate, and he said on a call that if we can trade the market and earn an additional basis point for an investor, we will. Now, we often hear that, hey, short-term trading is bad, you should just stick to long-term, put things in the bottom drawer, and just buy and hold. But why do you advocate for a flexible, high turnover strategy?
There's really two components to this. One is trading on stocks at a stock level. There's also the macro thematics. So we stick with the stock first. We'll talk through that now. So at a stock level, quite often you'll get intra-sector moves. So for example, Woolworths and Coles on one day, Woolworths could be up 1% and Coles could be down 1%. And you try to work out, is there a fundamental reason for this? And sometimes we'll trade that. That feels like an arbitrage opportunity and we will trade that. On the macro thematic level, quite often the way a macro thematic plays out is not in a linear fashion. You'll get movements in the underlying macro drivers and we will up and down our weights based off that. So there is really two aspects to that trading, one at the stock level and then one at the macro thematic level.
Okay, all right. So why don't we turn to the investment landscape now? What are some of the macro thematics which are really standing out to you?
Yeah, I mean, the clear one is rates are lower for longer. That has been well known, but it was really reinforced at Jackson Hole when Powell talked about the mandate change and rates being lower for longer, trying to help overcook inflation if they can. So I think investors need to be focused on lower rates for longer. What will change is nominal rates won't change for a long period of time. So that could be 3 to 5 years, no change in nominal rates. The real rates could change dramatically, and that is through inflation. So if nominals stay low, inflation picks up, you're going to have real negative real yields fall even more. So that's a key thematic we'll be playing, and you can play that through a variety of ways. Traditionally, it's played through long duration assets, which we've seen with tech and the like, and saw sort of the higher risk plays. But I think as time develops, this cyclical rally will pick up. Given conditions are very supportive, very loose on the financial and monetary settings. So I think cyclicals will play out. And the real way you're going to outperform now is picking that inflection point between the long duration and switch to cyclicals, which I think will happen in the next 6 to 9 months. But that will be a real key thematic.
What's the key signal you're looking for when when can I look at something, some piece of data on Bloomberg or wherever it is, where I can figure out, oh, that's the inflection point, we've reached it?
Yeah, I think the key thing to watch is the US 10-year rate and the spread between the 2 and 10 years, so the slope of the yield curve. What we need to see is a pickup in the slope of the yield curve. So as we talked about, the nominal rate will be set low, so the short end is almost anchored. What we need to see is the long end of the curve pick up, and that's the 10-year. So we start seeing that pick up, maybe the 10-year towards around 85 bips to 100 bips. That will be a good signal, and also the 2-10 spread. If we see that around 75 going up to 100, again, that will be a real inflection point, I think, in the markets.
Okay, so speaking of spreads, you're spreading your bets across your portfolio. So you've got a couple of components. Now you've mentioned some of those themes, inflation, cyclical. Talk to me about cyclical. How are you thinking about stocks in this bucket, and maybe what are some of the names that you're playing them through?
Yeah, I think the real key one here is financials. I've been a massive underperformer for a long period of time, and the reasons are quite clear. Economic conditions are poor, and those spreads we talked about are very low. So it's not the great conditions for financials. What we need to see a pickup is in rates and spreads and slope of the yield curve, and economic conditions. So I think financials, very neglected sector, and neglected for a good reason, but I think the conditions are almost right for a rebound in this sector, and I think that will be a key sector to watch coming out of this. On the cyclical front, you can talk about consumer discretionary, which have obviously had a really big short-term impact from the stimulus. So I think that sector is probably not a place you want to play, but for me it's those boring value companies that will get a good kick in the cyclical upturn.
Okay, what's one boring value stock you've got very high conviction in?
Yeah, there's a couple at the moment. So I'll touch on one. Scentre Group is one.
Yep.
So shopping centres, everyone thinks the future's not so bright for these. Even before coronavirus, the shopping centres were seen as an old sort of antiquated system of shopping. Everyone moving to online now. But what encouraged me about shopping centres is in July, August, there was a huge pickup in activity once things were opened up again. And Scentre Group is one company that we saw. They confirmed this, that there was a big pickup. Now, everyone thinks Scentre Group needs to raise money. I don't think they'll raise money at this level. They've got a few levers they can pull, especially on the debt front. So they've got access to debt capital markets. They can sell down assets at the asset level and still maintain ownership. So I think there's a few levers they can pull before they would raise equity, and they wouldn't raise equity at this point because it's too dilutive. And there's about 35 to 40% upside if they get back to NTA. So for me, that is a very much out of favour, out of love cyclical.
Sure. Okay, and then let's turn to the inflation side of things. As yields slope, inflation picks up. I believe you've got a hedge in your portfolio, and that hedge is gold. Is that right?
Yeah, gold's been a fantastic performer for us for a long period of time. Since about September 18, we were very long gold. Back then, when you look at how crowded the trade was, it wasn't crowded. We looked at the CFTC stats, which is speculative positioning, and it was very much underweight. Now it's very much overweight. So the conviction's a little less, but the conditions are set up great for gold. You've got fiat debasing, you've got expansive fiscal policy, inflation coming through. So the case for gold is very much still around. I'm just going to see how gold trades when rates start going up, if they do go up. But I think medium to long-term gold is a huge outperformer. I just think short-term maybe there's a few sort of headwinds as we transition away from low rates to inflation. There'll be sort of an adjustment period. So gold's still very much a position in our portfolio, around 3% of the portfolio. But to get high conviction now, I just want to watch how that transpires as we go through that inflection point.
Okay. What's a gold stock you like?
And we like Saracen. We think they got a good growth profile, and also Newcrest as well. Their acquisition recently, Red Chris, was great. So the other two high conviction gold stocks for us.
Okay. A fortuitous call you made in the weeks leading up to our discussion today was around technology stocks, that they're at risk of getting sold off, and it's happening. I guess I'd like your short-term view on this. Is this a tech wreck that we're seeing in recent days? Or is this a correction, and maybe what would convince you to buy into this sector because you're abstaining from it?
Yeah, it's a tough call. Like August was clearly exuberance. There was all these external factors driving the market up through, retail call options. There's the talk of the SoftBank options as well. So a lot of forced buying. The one thing I don't want to call a tech wreck because the conditions which led to the rally in these stocks still exist. So the conditions are still extremely favourable, but this leverage needs to unwind at this point. So it feels like it will keep unwinding. Who knows how low, but I think it'd be a bit early to call a tech wreck. To get a tech wreck now, we need to see the US stimulus package passed. We need to see rates pick up and inflation pick up. And if that happened, then you could call a tech wreck. But I think it's a bit too early to call a tech wreck. This is an unwind of the leverage in the system at the moment.
Okay. Are you finding any bargains? And tell me about your positioning in technology.
We still have a very small position in technology. The only one if you look at the Aussie IT basket is realestate.com that we own, and a tiny bit in Seek as well, due to fundamental conditions, but we're not playing any of the momentum tech at the moment because there is really no floor to their valuations, and it's very much driven on momentum, and at the moment momentum is in the unwind phase, so we're not playing that space.
Okay. What would convince you to buy into it? Would it be that scenario where rates are going up, valuations are coming down massively? Is that right?
If we saw another leg down in the rates environment and the slope environment, so the slope started to compress again, we would get favourable on technology. But at the moment, the rates and slope are flirting with breaking out, so we're not going to play this space because you've got the unwind and a flirtation with some of the rates and slope, and there's a few key catalysts coming up with the CPI in the US and also the care package we talked about in the stimulus in the US.
Okay, so you mentioned a key signal earlier on, watching the 10-year rate. What are some other charts that investors should watch right now? I think some other signals.
Yeah, I think volatility is one. So you can look at the VIX, which is the most common measure across various indices, but generally you just look at the S&P 500 VIX, and you can look at the Australian VIX as well. So this is a volatility measure. It just shows you people's appetite for buying risk or hedging risk. So at the moment, it's sitting around 30 in the US. In the unwind, it feels like we could go higher. So generally, I've got a rule where VIX hits 35, 40 in that range and fundamental conditions aren't deteriorating. It's generally a pretty good buy signal. When VIX is sitting in the low 20s, around 20, 21, 22, generally that's not a great buying signal, but it's signaling there's a lack of, there's a bit of complacency around. So I think VIX is a good signal. Also, a few of the metals are a good signal. The copper is a good one, the copper gold ratio. So there's quite a few, but generally you'd want to watch volatility because it just gives you a signal around how people are pricing risk.
Okay. Let's turn to the commodities sector in the WAM Vault filming that you did with Jimmy earlier. Something that you mentioned was that you're expecting or you're hoping to see the supply-demand equation come back into balance, which would be a good thing for oil stocks. Where are we at for oil? Because the prices are still well down.
Yeah, oil's tough at the moment. So it was really, a lot of people were saying this latest fall in oil was due to demand, but I'd argue it was due to a risk appetite. So when the NASDAQ fell apart, volatility exploded, and oil, you find a lot of the time when volatility explodes, people unwind risk across portfolios. So hedge fund managers might have a value at risk measure, and it gets hit and they have to adjust, and they always sell oil. So oil always gets hit in the first liquidation event, and it's been hit again. On the fundamentals, oil use is grinding up. So I think the dynamics are very much in favour of energy in the long term. Just this short-term noise we're going through on a risk unwind will probably continue for a week or two. There is talk of OPEC extending cuts, which will be a fantastic positive because US shale is falling apart and the oil demand will come back. There's about 15 million barrels odd per day to go till we get back to normality. So I think the conditions are still very favourable for energy.
Okay, what's the weighting for oil in your portfolio, and what's the way you're playing it?
Okay, the weighting's around 4.5%, predominantly through Santos and a little bit through Oil Search as well. Woodside is starting to look attractive at these levels, around $18
Yep.
odd. But again, it's got its own issues at the moment with the growth profile and some of the moving parts that need to happen in the short term. But I think Sandos, Kevin Gallagher, fantastic CEO, put that company in a great position. They have the most flexibility and probably one of the best operators at the moment.
Okay. Adjacent to energy, resources. Something that was a bit spicy was a call that you made on Fortescue at $8. What a cracking call, because today it's at $16, $18, something like that. It's paid massive amounts in special dividends. Where are we at for iron ore and resources?
Yeah, iron ore still looks quite favourable. So the pickup in China was fantastic. The use of steel, we were growing 8% year on year in a few months. Iron ore still looks pretty good. When we talked to Fortescue recently, they were talking about some of the port inventory. So with the fines product, the port inventory was around 60 to 65 million tonnes, and normally that sits around 80 to 85 million tonnes. So there still is a shortage of inventory at the port for the fines product. So I still think conditions are fantastic for iron ore. Vale obviously is increasing some of their output, but the rest of the world should pick up steel production, which hopefully will soften some of or absorb some of that Vale supply. So iron ore still looks good. They're printing huge amounts of cash at these levels and still look like a good forecast period for them.
Okay. Now, before I come back to your portfolio, is there any other sector that you want to point out that you're extremely bullish or bearish on?
Yeah, insurance is an interesting one because everyone's really worried about business insurance through the pandemic and closures of business. I think there's a great opportunity here for IAG. It's being sold off aggressively. The company is taking a very conservative approach. The share price is almost factoring $1 billion, $1.5 billion of claims in business insurance. And I think the claims will be much, much less. So for me, IAG is a clear standout. And the premium cycle is hardening very fast.
Right.
So I think insurance looks good, and obviously that will get a kick up if rates go up as well. So you could get a double kicker here through sorting BI out and then getting a rate increase too.
Let's turn back to your portfolio. So you've got all these individual bets. You're looking at these different themes, but how much is your cash weighting?
Yeah, cash is around 5.5% at the moment.
Okay, how's that changed?
It's changed a little bit, not a huge amount, because most of the way the portfolio is set up, you balance out the risk. So sometimes you'll take cash up, but the beta of the portfolio could move around a lot too. So when I look at the portfolio beta, it's probably around 1.05. So every 1% the market moves, the portfolio will move 1.05%. So it's got a fair bit of beta in there at the moment.
Okay, and is it that 10-year signal that will make you chuck in all of that cash back into the market?
I think the mix will change. Generally like to run a little bit of a cash buffer for flexibility, but it will be the composition will change dramatically. Would take out a lot of those beneficiaries of the low rates. So a lot of the REITs, which are more priced on cap rates rather than activity, will get reduced. And there'd be quite a few funding sectors. Consumer staples will probably be would reduce that and put them into the financials, I'd say.
Matt, something I'd really love to understand is the WAM Leaders dividend strategy. In a year when the market has been cutting its dividends by around 30%, your portfolio has increased its by about 15%. Tell me how you've done that.
The way we pay the dividend is a combination of the income we receive from our positions, but also the capital gains that we make. So at the moment in WAM Leaders, we have around almost 3 years of dividend coverage at this level.
Sure.
So we're in a very strong position on capital, and we can keep paying that dividend at those levels for the next, I think it's 2.75 years.
2.75 years. So let's delve into that quirk. 3 years of capital gains. Is that capital gain sitting there banked and you don't touch it, or does it go into the rest of the investment pool and you're still trading it all?
No, that's in our accounts as a profit reserve.
Yep.
So that gives us the ability to pay out of that profit reserve for that period of time. So no matter what happens with the markets, obviously it's a board decision, the dividend, but we have the ability to pay a dividend for those amount of years.
Let's finish up with some reflection. What's the biggest investing lesson that you've kind of learned or found this year?
I think it's around fear. In March, when you get all the commentators and the world's going to end, all the companies are worthless. At those times, you really have to go through, and we did quite an easy exercise. We went back to the GFC and we printed off all the stocks and all the share prices around the GFC levels. And then we just started shopping. We had a shopping list of all the companies which were hit. And one, for example, Stockland was back at 1991 levels, which was our last recession. So Stockland at that price, it was a no-brainer because you had this massive policy support which we could see was coming. Star Group, the casino operator, trading well below its net tangible assets. And again, they've got, you could call it not a monopoly, but it has a license which can't be replicated. So you're buying this business below its book value. There was numerous examples of these through that period. So if you keep your head, take the emotion away, and just look at these share prices and push them against fundamentals and have a look. But yeah, just don't get caught up in the greed. And also, it was the fear, I should say, but greed similarly, like in the tech. When it's too easy, it generally ends pretty fast.
Hey, I love that checklist idea. Maybe can we dig into that more? So you printed off a checklist of what to buy if the market crashes. Okay, and I think one of the biggest things with investors is when the opportunity is there, then people are scrambling to figure out, oh gee, what do I buy? Tell me more about the checklist. When you put your stocks in this, is there certain criteria that you look for in this? And do you mind telling me what some of them are?
Yeah, like we had, it was quite simple. It was an outright share price level, a PE level, and a price to book level. So 3 columns with each ASX 200 stock, and just comparing it versus the GFC as one check. So some of these companies like QBE at a time had the trifecta. It was like a lower PE than the GFC, a lower PB, and a lower absolute share price. Like it had the trifecta. So when you look at it like that, it takes away some of the emotion around it. And is it as bad as the GFC? The hit was probably worse, but we knew the policy was coming and the duration would be shorter. So it's really a case of just having a few simple checklists and then going through them.
Okay, but as you're going through that experience, you've got the checklist there, and I get you've got your valuations. I guess, especially with COVID, some people might have in the back of their mind, oh yeah, but the world's changed, right? We're all going online. Business is going to go broke, so who's going to need more insurance policies, etc. How do you think about what the valuation is versus any structural changes happening to those same companies that you're buying?
Yeah, I think the big lesson in history, when you go through history, is everyone overestimates the change that will happen with the world. Like you look at the events we've gone through over history, and nothing really changes dramatically. So in the midst of the event, you feel like it will be a world-changing event, but then normality comes back quite quickly. So we've been through numerous wars and pandemics and all sorts, and nothing really deviates too much from the mean. So you get that initial shock, but then life goes on. But in the midst of it, it feels like it is world-changing. But history has shown through many, many events, things don't change dramatically on a lot of the way humans interact, and also spending patterns are incredibly sticky as well. One of the most stable things is people's consumption. The big variables are business investment, and they are the ones that swing around more dramatically. So they are the areas where you have to pay attention, but people's spending is remarkably resilient.
Okay, last question, I'll finish on this one, Matt. What's one process improvement you're going to make to the management of your portfolio? You've already delivered a great performance, but managers are always looking to continuously improve. What's one process improvement that you think you're going to adopt on the back of what COVID's taught you?
I think it's probably, without too much reflection, it's probably going harder on positions when they present themselves, trying to capitalise on them more. It's a double-edged sword, because if you get it wrong, obviously you lose more. But I think when you've got the high conviction, it's really trusting your instincts and probably going a bit harder. Because if I look at some of those opportunities we talked about earlier, we should have put a lot more capital into those at that period of time, but we were going for those, but also trying to hedge out a little bit of the risk. But in hindsight, and even in fear periods and in greed periods, it's probably going a little bit harder in that direction. But that's probably the main thing I could take out.
So go hard, have your checklist, and buy into the storm with courage. Love it. Matt, I've learned a lot from you. I'm sure investors have too. So thank you so much for your time.
No, thank you.